Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. I'm your host, Josh Knoll, alongside co-host Michelle Lee Melton.
Hello.
The oats to my Hall, the ginger to my Fred.
Tenniel to your captain.
That's right. Us listeners get those references. How you doing?
I'm doing well.
Great. All right. Well, here we are again. We're in Coastal College's recording studio, beautiful downtown Fairhope. And I have a hankering and a feeling, Michelle, it's going to be the best show we've done so far. What do you think?
The material's a little dry and maybe somewhat depressing. So is that a prediction that we need to put down?
That's a prediction we need to put. This is going to be our best show ever. So here we go. Listeners.
Well, I certainly hope so.
Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Now, if you're just tuning into the show, we want to welcome you. You're listening to what we consider Lower Alabama's most dynamic financial radio show. Here's what we got in store for you today. First segment, deep dive on our topic of the day, what Michelle calls a little dry this go.
Well, it's dry take two.
Try take two. There you go.
Because it's a continuation.
That's right. Second segment, about 20 minutes past the hour, fan favorite, Michelle with the news of the week.
No, that is true.
There you go. Third segment, roughly 40 minutes past the hour, Jocelyn's crystal ball and
big mouth.
That's right, big mouth. So buckle up. We got a lot to get to. Quick background on those of you that are new to the show on me. Again, my name's Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We've got offices in Fairhope and Orange Beach. Got some news on the Fairhope office actually coming up.
Yeah, it's very exciting.
You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you miss that contact info, do not worry. We will repeat it several times throughout the show. So, Michelle.
Yes.
This episode is part
Double
2.
deuce.
That's right. It's our part 2 of our mini-series.
It's a triple deuce then.
Well, it's just part 2. Interest rates.
Isn't it episode 22?
It's episode 22. Oh,
part 2. You see what I'm saying?
That's right. Yeah, 3 twos.
Numerology, dude.
Yeah, 4 of a kind is the only thing you got to worry about here. It's our part 2 of mini-series on interest rates and bond yields and how these things relate to the stock market and the overall economy. And the big question of the day, are we headed for a recession? I think a lot of people are asking that, right?
Yes, for sure.
All right, so listeners.
And predicting it or not.
That's right. So, and we're going to talk about that. Listeners, you can find that previous episode, part 1, and all of our previous episodes, all 20 some odd of them now, on Spotify or on the podcast tab of our website, gulfcoastfa.com. But for now, let's do this. Let's just sum up what we talked about. On the last episode, rapidly rising interest rates have caused havoc in the bond market, resulting in 2 major impacts to retail investors. So first, investors' existing bonds have decreased in value, current value or price, because anyone buying existing bonds with a lower interest rate than they can get on a new bond is going to demand a discount in price, especially on longer-term bonds, or put it another way, a higher yield to accommodate the fact that the investors will be making less interest during the duration of the bond, okay?
Gotcha.
In short, what it means, as interest rates rise, existing bond prices will decrease and yield will increase. Now, this fact alone is enough to beat up bondholders, but the second piece that has had a broader impact on the overall stock market, including equities, and it's called the inverted yield curve. Basically, what that means is that interest rates on longer-term debt instruments have lagged the interest rates on short-term securities. There's a higher demanded yield, higher compensation on shorter-term securities, which means it's out of whack. It's inverted. So why is this a bad thing? Really, what it comes down to, investors and consumers are conditioned to the Fed reducing interest rates to prop up the economy and the stock market. And if interest rates are projected to be lower on long-term securities, that means, in general, that investors and consumers have a negative outlook on where the economy is heading because they're anticipating the Fed will lower rates. Get it?
Got it.
How it all circles around.
Mm-hmm.
So here's the thing. As a numbers nerd, one of the reasons I appreciate these two facts, versus some of the emotion that can go into the equities market is because it's just basic math. Interest rates have risen. Bond prices have fallen.
Down.
Long-term rates have lagged behind short-term rates. Short-term yields out of whack with long-term yields. It's all black and white. What isn't so clear is what this means for projecting a recession or even just an economic contraction. So what we're going to try to attempt to do today is use the basic math of what's going on in the bond market combined with some life experience and some common sense to answer the question that's been on everyone's mind for some time. Are we headed for a recession?
Dun, 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 dun.
Okay, so here's the thing, Michelle. As we dive into this question, I'm going to pull the rug on you and the listeners.
Oh, wow. Okay.
And here's why. Well, because the short answer to the question, are we headed for a recession, is yes. Yep. Yes, sirree.
Okay. That's my feeling.
Well, but there's nuance. There's context. First, the answer is always going to be yes because of how we have set up our market-based economy. Our economy, by design, is defined by the business cycle of expansion and contraction. For example,
it's like gaseous.
It's how it works. It's never a straight line. All right. On the expansion line, or expansion side, if you will, there's always some input into the equation of predicting where the economy is heading, some factor that's going to lead to investment in particular parts of the economy. And often that input or that input is fueled by either Fed interest rate or monetary policy. And typically what happens is that part of the economy will peak and then it'll contract or recede. Mm-hmm. So let me give you an example of a changing input that I think will resonate with our listeners.
All right.
Most of you all listening, or many of you all listening, are probably part of the baby boomer generation. So I want you to take a minute and think about what the sheer volume of human beings in your generation has meant to construction, to housing, to medical care, the service industry, on and so forth, right? This is an input that led to the expansion of many parts of our economy permanently, really.
Mm-hmm. Yeah, it hasn't contracted.
It hasn't contracted,
yes.
That's right.
Some of those are, if not all, are still expanding.
100%.
Yeah.
Now, on the contraction side, long-term high interest rates, high bond yields, high borrowing costs, these are things that are always going to contract the economy eventually anyway. That's a point of raising interest rates to eventually tamp down demand to make the economy contract. And I can tell you, somebody that graduated with an economics degree from the Harvard of the Midwest, some would call it Missouri State University, when you have less demand than supply, prices eventually fall and the economy contracts. Okay. So what that means, my opinion, the question isn't if a recession is coming, because the answer is always yes. And in this particular case, there's a chance that it's probably sooner than later. So what that does, that leads us to what I think are two more important questions to ask.
Number two.
Yeah, number two. We're 5-2s. Now we're playing Deuces Wild here or something.
I don't know, but I feel like that's a winner.
That's right. All right. So first, these are more important questions. Assuming that we are all in agreement that at some point or another, if you predict a recession long enough, you will be right. Okay?
Okay.
All right. So more importantly.
So we should always predict. We should always say yes.
Well, it depends. Here's the thing. Here's what here's the real what we really want to address. First, what part of our economy, what input is going to produce the runny nose that eventually leads to the full-blown flu? Is that a metaphor or a simile when I'm saying that?
I think it's a simile.
A simile. Okay. So the economy gets sick. It gets a runny nose. What input leads it to eventually having full-blown flu? How bad does the flu get? Do you just need a steroid shot in the butt and you move on, or are you hooked up to a respirator as far as the economy goes? What would be this input? Does tech finally come back to earth as far as market cap valuations? Does lack of cheap money lead companies across the board to abandon growth mostly or completely? These are big, broad inputs, listeners. And I hate to tell you this. You don't only have limited control over that part of the equation, right? The second part that you have considerably more control. Do investors have any option to protect their investments against a recession?
Ooh, pray tell.
This is the question we need to be working on. Okay, so Michelle, let's do this.
Okay.
Let's say, it sounds like I'm saying we're heading for a recession, right? And it sounds like I'm glass half empty, which
is not you typically.
Kind of out of character, right?
Yes.
So as a counterpoint to my opinion, savvy listeners are going to point to the fact that the major indexes, the Dow, the S&P 500, the NASDAQ, these have been fairly resilient throughout this rising interest rate environment and decreasing bond price situation, or at least they were up until recently. It's been kind of a rough week with the market. So why is that? Do you know? I'm going to answer.
Okay, perfect. I was thinking you might.
Well, it's primarily, here's why, Michelle. It's primarily, and we've talked about this on past episodes, it's because the largest of the large cap companies in these indexes have shown the least decline, generally speaking. In fact, they've actually shown the most growth. More specifically, if you look at another index called the Russell 1000.
Never heard of it.
It's the highest market cap companies across all the exchanges. Okay. So I don't know who's the top of the Russell 1000, but I would hazard
who Russell is.
Well, I would hazard a guess it's Apple, because Apple's got somewhere around a $3 trillion market cap. You're going to be hard pressed to find a company bigger than that, right? So if you take the 200 or so of those largest market cap companies in the Russell 1000, they've had a pretty strong year, even considering what happened this past week. But the bottom 800-ish or so are on average down for the year. What does that mean? That means in general that the largest 200 companies in America, based on market cap, have been the primary reason that the overall indexes haven't seen significant dips this year. This has been a top-heavy rally.
Sounds like it.
Well, let's drill down, be even a little bit more specific. You've heard me, the Magnificent Seven. Does that mean anything to you?
It's a movie.
Yes. I don't even know who's in it. I can't remember.
It's old.
It's an old movie, right?
I mean, it might be John Wayne in it.
I don't know. Some of our
Steve
listeners
McQueen.
are yelling at us through the radio.
We're going to get some angry emails like, you guys should know this.
We should know this. Well, we're not talking about the old movie. We're talking about the Magnificent Seven stocks. What are those? Those are Apple.
Ooh, that's the one you just said. Or Russell.
Well, that's Russell one. That's an index.
Yeah, right. I know.
So Apple, Microsoft, Alphabet, which is Google, Amazon, NVIDIA, Meta, which is Facebook, and Tesla, which Tesla's been banged up a little bit.
Yeah.
But
that's in there.
These Magnificent Seven have carried the water for most of the overall stock market averages for 2023. These companies have also shown the most resiliency against higher interest rates and the discounted bond market.
Well, good for them.
Yeah, that means the rallies have been top heavy, like I just said. So why is this? Why in an era of increasing interest rates and bond volatility, Michelle's favorite word, have these companies nearly single-handedly help hold serve on the market? Because let's go back to what we talked about in the beginning of the show. These companies and most of the largest cap companies are in a position
sitting pretty.
They're well capitalized, where they do not have to refinance into higher interest rates on their bonds. And at least for most of these companies, consumers keep buying their products for now.
Yeah.
Again, Tesla showed some real weakness here this last week or so. Okay. So let's do this. Let's land this plane. Let's get back to our original question.
Okay.
If bond prices are falling and yields are increasing, and we're in a top-heavy stock market valuation, and the yield curve keeps inverting, and more concerning, bond yields keep breaking through that significant line of 5%, does this mean that a severe recession is right around the corner? Well,
I don't know.
Again,
what's severe?
There could always be a recession. There will be a recession at some point. There always has been. It's baked into our market-based economy. What I'm asking you listeners to do is take a step back and view this question differently. If the math tells you that danger is probably ahead, whether that danger is miles in front of you or just a few yards ahead of you, what can you do to be prepared? All right? So the first question really for you all and your individual investment is, what the heck is actually in your portfolio? Are you seeing ups and downs with account balances that make you nervous or even maybe lose sleep? So this is about talking about being prepared for what's ahead here, Michelle, right? So, and I can't tell you how often someone comes into our office with an investment statement, a portfolio statement. It's supposed to be on the conservative side. And when we do our analysis, we have
wild.
It's anything but, more often than not. And it's not that investors should avoid all risk. We're going to talk about having risk in your portfolio later in this episode. But most investors really they rely too much on what they're being told versus what they're actually holding. As we've joked on the show, I am from the show me state of Missouri originally, but down here 9 years. So if you're an investor listening to the show, if I were you, I would want someone to show me what I'm really invested in. Don't just tell me, show me. So, and on that note, we can do that at Gulf Coast Financial Advisors. It's a nerdy thing that I love doing. 251-327-2124. The second step is educating yourself on what options are out there, particularly if you're in or near retirement, and especially if you're someone deeply concerned about a recession and the impact that will have on your portfolio. Not to pick on you, Michelle, but you're on the
You say that a lot, however.
You're on the younger side, and if you are, so think about it this way, you've got many years of accumulation ahead of you. So if equities are selling at a discount, if someone were to ask you, would you like to see the market go up or down this year? What would you say?
I would say go up.
Okay. Why?
Because end on a high note.
Well, fine. But you're buying these products.
Am I?
You're buying into the market at a premium.
Okay.
Wouldn't you rather buy into the market at a potential long-term discount?
I just want everybody to be happy and be making money.
Well, here's the thing. You and I, we are in our, what do we decide? We're not midlife crisis, but
we're midlife.
We're middle age.
We're middle aged.
Yeah, we're not. Is that a token thing? We're middle.
I mean,
Earth.
I guess I don't. I think we're middle aged, but
technically we're middle aged. But here's the thing.
Probably going to expand within the next 10 years.
Like my waist. So here's you listeners, you're sitting there kind of on the other side of that. You don't have years of accumulation ahead of you. You've done that, and you're not really, yes, you'd like to find a few discounts here and there with some of the stuff you do, but really what you're wanting to do is preserve the integrity of the accumulation of the bucket of assets that you've created, right? So there's a positive flip side to this, to all this stuff we're talking about, particularly as it comes to high interest rates or the high likelihood of a contraction, right? There are the offerings right now, and this again comes back to we've already talked about this. Is there a recession coming?
Yes.
Yes. When? Who knows? But it'll be sooner than later, right? It's just part of our economy. We've dodged a bullet for a while. It's on the horizon. And sometimes when you talk about these things, there is a self-fulfilling prophecy. So there's going to be some type of contraction. We're going to talk more about the details of it later in the episode. But on the flip side of that, you have got offerings on fixed income. You folks that are in or near retirement, there are things out there now on fixed income and fixed interest offerings and interest-bearing securities that are as attractive as they have been in years. Okay?
All right.
So
that sounds good.
Right. So here's the thing, Michelle, as the Gulf Coast self-designated honesty broker, I'm going to shoot you all straight, even though sometimes it does me no good. You can buy most of, not all of these fixed income and fixed interest investments directly yourself, listeners, without using a broker or an advisor as an intermediary. Treasuries, bank CDs, municipal bonds, corporate bonds, et cetera. A broker is going to charge you a one-time markup or a commission on most of these, or an advisor like me is going to typically charge an ongoing fee for managing the investments. Now, if you don't want to pick these things yourself, if you don't want to do it yourself, or you've tried it and you don't like it, which is usually the case, then give us a shout. We can discuss all the options out there. Not just the things I just listed, but there's also really attractive things going on with MYGAs, multi-year guaranteed annuities, money market funds. I mean, 5.25 right now in a money market fund. Bond funds, et cetera, right? It doesn't mean, as anytime we list these things out, everything I just listed to you has some element of risk. Generally speaking, they're not going to be as risky as you would see in just a straight ownership of a stock or an equity, but all investing involve risk. Well, the things we're talking about are things that are offering interest rates to people that have the ability, whether it's repositioning assets they already have invested, whether it's cash sitting on the sidelines. There are things you can do right now that 18 months ago, even 12 months ago, were not nearly as attractive with the yield and the interest that they are generating. And here's the thing, how you stitch all of this together where you can actually make an educated decision. Have a financial plan to reference how all the parts
Come see Josh.
That's right. You call us. We can help. So how do you start the process of working with us? Pretty easy. First, you can set up a no-pressure, free, no-obligation conversation. You can do that by clicking on the calendar link upper right-hand corner on our website and scheduling a call. The website, again, is gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, as in the show title, FA as in financialadvisor.com. Or you can always simply call 251-327-2124. That's 251-327-2124. All right. Any questions before we pivot to the next segment, Michelle?
Not from me, not at this moment.
Right. That's as negative as I'm going to come across, but that was solution based, right? There is a way to navigate what is probably coming down the pipe, whether it's tomorrow, whether it's next week, whether it's a month from now, a year from now. If you're sitting there and you've got the ability to put things into investments that can give you, again, some of the more attractive interest rates and yields that have been available to retirees in years, if not a decade and a half, then it's worth a phone call. Okay, 251-327-2124. We can have that conversation. All right, folks, coming up next, every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. So why don't you join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back to Coasting in Retirement. Your host, Josh Knoll, here. So as we discussed before the break, every week Michelle and I scour the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job is to help you all understand how these headlines impact you, especially when it comes to your money. So without further ado, here's Michelle with the news of the week.
All right, Josh, let's kick it off with a recent article from Forbes titled Recession or Soft Landing? What's next for the U.S. economy? This article talks about the historical lag of monetary policy on the U.S. economy, check, saying that it usually takes about 18 months for the full effect of rate hikes to kick in. However, by my count, we are right at 18 months now, and since the Fed started increasing rates, and based on recent economic news, this appears to be correct, and I feel like people are feeling it already. So this article also mentions the inverted yield curve and its case against a soft economic landing, but points to strong employment and decreasing inflation in its case for a soft landing. So, which is it? Are we headed for a recession? And if so, will it be a soft landing or a kersplat?
Kersplat. All right.
Oh, no.
No, I'm making fun of how you said that.
Okay.
No. So here, all right, let's do this. First, the case against a soft landing. And here's the funny thing.
Oh, and it reads 56% chance of recession in the article. Yeah. And it went down 10% since last month or August or something? Okay.
Yeah, I mean, sometimes I wonder why they even predict this stuff. It's like to give themselves a job.
Yeah, because they did a terrible job earlier this year with the banks and stuff. Anyway, so whatever.
Here's the other thing, too. So in the case for a soft landing, it's funny. When we had low inflation for years, do you recall how much they griped and complained about the unemployment rate? It was too high, right? Yeah. Now, there were some years where it was low, and now, and again, you and I sound like the, get off my yard guy here, but
not in my backyard, NIMBYs.
Not that, no, the Clint Eastwood. But the thing is, unemployment now. Okay, so now you got higher it's coming down, but you've got historically low unemployment at 3.8, 3.7%.
And jobs keep on showing up month after month, and they're not believing it.
And now they're like, oh, great, employment's great, but now I got to worry about this pesky inflation. We got to get to this magic number of 2%. So the case for the soft landing is there's a lot of jobs out there. I still scratch my head because I feel like there's a lot of young people not working, but maybe that's just because I'm getting old.
They're influencers, Josh.
Maybe that's what it is. But on the flip side of that, what we're seeing is we talked about this on last episode, we talked about in the opening of the show, anytime that investors are demanding more compensation on short-term treasuries and fixed income versus long-term, that means that they are viewing that the economy is eventually going to get into negative territory, and the Fed is going to do at least what it's done since the 80s-ish with Greenspan. The Fed's going to drop rates to rescue both the economy and the stock market. Okay,
or will they?
Or will they? So that's a great pivot. We're going to talk more about this. But
Okay.
Jerome Powell, our current Fed chair,
Yeah.
as in contrast to Alan Greenspan, longstanding Fed chair that some kind of point the finger at for maybe causing the housing bubble to some degree by keeping rates too low and letting subprime loans run a little amok. Anyway, they are very different people, very different approaches.
Yes.
Jerome Powell has made it very clear in his words, and he's finally kind of started getting the market to understand that he's putting his money where his mouth is. He's not concerned about the stock market.
Nope, doesn't care.
In fact, all indications are that he would be more comfortable if unemployment would go up, if the stock market would go down in value broadly across the indexes, and he feels like that would couple directly in trying to get this inflation hammer going down. I think he's a little bit of a history buff, and he looks back to, you and I were just babies in the early 80s. Both of us were born mid-70s, but I don't remember his name, and I apologize, listeners, you may remember, but the Fed chairman back then kind of took one for the team, and he went super high on interest rates, and he basically broke the back of inflation.
Okay.
Unfortunately, he kind of broke the back of Carter's presidency, and he also broke the back
Carter.
of the economy,
Wow.
and he paved the way for better or worse.
Yeah.
We had a good run with Reagan, but he kind of
with the monies,
Yeah, he kind of paved the way for Reagan, but he more or less kind of, like I say, he took one for the team, more or less. So what does that mean? Soft landing. Right now, the indications are we're looking at a soft landing, again, because unemployment stays low. We do see inflation heading down, and we don't have any particular part of the market going crazy outside of tech. So I'm going to say that a lot of the answer to your question is going to come down to what happens to tech. Does Apple, who has such a ridiculously outsized position of value with these indexes at a $3 trillion-ish market cap, if it were to market correct itself by 20%, if the iPhone 39, whatever is
it's 15.
Okay, if the iPhone 15 all of a sudden started exploding.
Isn't it already?
Well, I mean, really.
You mean like really exploding, like hurting people? Yes,
right.
I got you.
And
okay.
all of a sudden they lose 20% market cap.
Gotcha.
Now we might have one part, just like we have with housing, we might have one part of the economy bringing down the rest of the economy. Right now, it appears we're heading for a soft landing, but
He's on it.
As a point
it's
of
like
this,
a water landing.
Well, yeah, there you go.
But with a water plane, you know what I mean?
You hope.
Not the other way
Not the
around.
Hudson?
I'm thinking, no, not that one. I mean, even though he did a good job, but
Scully? We got Scully.
I'm talking about like the mail delivery and stuff, those planes in Alaska.
Well, and the point of this episode, and I know you got a little bit more strongly worded article coming up next, but the point of this episode is, let's assume that it's whether soft or hard landing, there are things investors can do right now to get prepared. And if you're not, you need to be having those conversations. 251-327-2124.
I actually do want to get, that's a good article. And it mentions Atlanta, which had some kind of Atlanta index or something, or model that I'd never heard of. So that was neat, bringing things to the South.
I like it.
Yeah.
Very good. What's next?
Okay, well, next up is CNBC coming at us with a more strongly worded article titled, quote, "A recession is coming and investors should be defensive. TCWCO says." Like we're supposed to know who that is. And then I transposed it and thought it was the Weather Channel. So, but anyway, just kidding.
It's originally the Trust Company of the West.
Wait, really? Because I didn't even find out that much.
Yeah, everybody knows that.
They do not.
I didn't know it either.
Exactly.
I knew TCW. I didn't know what it stood for.
Okay.
Fooey on me, but keep going.
Yeah, okay. So, we've researched a lot of articles for coasting retirement, and we've often shown how analysts, I can say that this week,
yes,
can talk out of both sides of their mouths when it comes to predictions, sometimes even on the same website. So my first thought on this headline was, clickbait.
Right.
What's going to happen, soothsayers? But CEO Katie Koch says that we haven't had a real recession over 15 years and that the pain of higher rates is on its way. Again, I just feel like we're there. But okay. She makes a case that investors shouldn't wait around for this pain and make some conservative move now.
Which we talked about.
Yes, such as looking at treasuries, T-bills, and well-capitalized companies. Do you agree or disagree?
Well, okay, so fundamentally, yes. I mean, we kind of laid that out in the first part.
Right.
Do I necessarily agree that a recession is coming and right now? For that part of it probably is a little clickbait. No one can predict it. If you can, then sometimes you get lucky like those guys did in The Big Short where they predicted the housing market crash and they held on. But even here's the thing, Michelle, even though those guys end up making billions of dollars, the one that was played by Batman in the movie The Big Short, Christian Bale, right?
You love him.
I do as an actor, yes. But they still had to hang on for many months, sometimes years, on their positions until they were proved right. Yeah, some of those guys held those positions, those options for many months. here's the point. Yes, do I think that investors, especially those of you in or near retirement, maybe need to consider looking at some conservative moves on part of your portfolio? I think that's fair. But allow me to pivot back to my glass half full personality. And I do want to kind of give investors a little ray of hope. There is historical data that rates can be high and the stock market can still perform well. Investors suffer from amnesia, or maybe you maybe just weren't old enough. But a lot of you all will recall that during the 90s, the average yield on a 10-year treasury was 5.2%. And if you remember the 90s, the market performed reasonably well over the course. After 91, 92, the market did fairly well. That scenario is almost exactly where we are right now. The difference is the shock and the speed of the rate increases and the unknown of how long these rates will stay high, because, again, we don't have Greenspan, who was very stock market plugged in, sensitive. We have Jerome Powell, who, by all appearances, is not.
Snubs it.
Right.
Yep.
Greenspan conditioned us to, really having the Fed come to the rescue before the economy broke, okay, or the stock market broke anyway. And the funny thing is, he started doing this. The first I can remember paying attention to this as a young Family Ties nerd is 87 was Black Monday, I think.
Yeah, I think you're right.
Yeah, most people don't realize 1987 at the end of the year, the S&P actually ended the year positive. They just remember 1987 is Black Monday and the market was down, but they actually ended up at the year positive. And Greenspan took a lot of credit for that because he was very aggressive with cutting rates. Okay.
All right.
So here's the
history
thing.
lesson there.
Part of investors, those of you in retirement, part of your plan should be defensive, right? You should have some type of capital preservation. You should have some type of income production. There needs to be things of your portfolio arrangement that need to be going.
So you'd have some right hooks in there.
That's right. But you also there needs to be part of your portfolio that is playing the long game. And here's the thing, I believe with all my heart that part of your long game needs to be a long-term bet on America and its companies, that these companies will improve their profit margins over time, that the products will get better, they will get more efficient at their operations. And these are the kind of companies that you want to hold on to. Apple, we talked about Apple, Microsoft. How long has Microsoft been around, right? That's a really well-run company.
Yeah.
And here's the thing, Michelle, if an investor's world philosophy differs, if they're constantly trying to make a profit off the failures of the market, then they're a trader. They're not an investor.
Right.
And that's okay. If you've got a trader mentality, you're probably more bearish than the average investor is right now, and that's okay. Just have some self-awareness of what you're actually looking at. All right, very good. Nice job.
All right, Josh. Let's pivot to a new site I found.
All right.
Always exciting. Investors Business Daily.
I'm in.
It was, and I liked it. They had spooky things going on for Halloween, spooky season.
Right.
A little ticker at the top. I enjoyed that. So they have a fresh off the press article titled Strategies for Investing in a Rising Interest Rate Environment. This article is super detailed and fairly long. However, listeners, the paragraphs are really short. It's like 3 sentences in each. So it made it more, it was easier to read. So it has a lot of good common sense advice. For example, it talks about one of my favorite industry jargon terms, laddering, with regard to holding bank CDs. It also mentions that investors should diversify their bond portfolio. Knew that. Which I found interesting, though, because I've always thought that diversification was more about the stocks and mutual funds that I own. Because you do think about diversity in your portfolio. I think about stocks.
You do, right.
Yeah. Okay. Lastly, the article talks about the industries that tend to do well in a high interest rate environment versus that do not. It makes total sense that the auto industry and retail tend to do poorly when rates are high. Such things as utilities, energy, and food do well, however. So this article did get pretty technical towards the end of it. So with so much meat on the bone, I'm just going to toss it to you.
Well, I told you I love this article. In fact, I loved it so much that I think we're going to use it as kind of the basis for our next episode. Because, it is... honestly, I kind of wish I'd written it. It makes my blog contribution not look that impressive. This is really well researched, but it talks about a lot of the things that if you're already listening to this show, then you're already trying to get better at this stuff and you're paying attention to your money. So this article really falls in line with the demographic and the mindset of people that listen to Coasting in Retirement, in my humble opinion. But it definitely gives you some action items. It talks about investing in treasury bills directly.
We like action items, don't we?
We do. Yeah, we talked about hey, you don't necessarily need a middleman on some of this stuff. Just buying and selling of these things are not that complicated with technology anymore.
I can even do it.
Well, I mean, so the value would be with somebody like me is, how does it stitch in?
I don't want to do it.
How does it stitch in with the rest of the financial plan?
Right.
And
it's just a piece.
Yeah, you did it. Michelle would do it one day and then be like, oh my gosh.
I would. I'm exhausted. I'm going to be ruined.
Right.
Yeah.
Laddering CDs, laddering bonds, fixed income investment strategy. It talked about diversification in your bonds. That is critical. For those of you all that were really heavy into one part of the bond market, say you were really heavy into municipal bonds, and especially
if
they were longer term, then you're seeing a pretty banged up price point on those existing bonds now. It's not the end of the world if you hold them to maturity, but it still doesn't make you feel real good looking at them. So yeah, great article. We're going to come back to it again.
Yeah. Lots of info.
Yeah, lots of info. And it gets back. It kind of stitches in with some of the things that I believe in. I don't remember the guy that said it, and I'm doing this off of my head, so I'm going to misquote him, but he said that the stock market is a voting machine in the short run and a weighing machine in the long run. And I've always liked that. And so it talks about picking stocks in this type of environment, voting versus weighing. It doesn't use those words, but I can see through that it talks a lot about value investing, because I'm a fundamentalist in the long run. I do believe that the market weighs actual profit, actual losses, actual cash flow in the long run. In the short run, there's a vote. It's a voting thing. It's an emotional thing. We invest for the long term. Tends to work out better for our clients. Very
Voila.
good. Voila.
Okay. All right. This is our last one for today, and it's from our good buddy Chuck Schwab.
Oh, Charles Schwab.
That's right. It's called Phasing Retirement with a Bucket Drawdown Strategy. And to be honest, you found this article actually and gave it to me.
Yes, I did.
And I struggled to see how it fit with our other Michelle with the News of the Week headlines. But once I read it, I think I get it. I'll be the avatar for our listeners.
Good.
Okay. So, Josh, you've spent most of your time in this episode laying out ways to be defensive, right hook, quick punch, in the short run with investments while also capitalizing on high interest rates. But you also keep talking about how most investors should still consider having some of their portfolio in higher risk investments like stocks and equity-based mutual funds and ETFs. This article lays out how folks that are in or near retirement should put their money into different, quote, buckets, unquote, of investments. And I think this ties into what you've been saying. So do you want to expand on that? And I think there's a psychological benefit when you do, when you do spread things around, have the different buckets,
Well, because again,
you're not just like putting all the eggs in a basket.
Right. We've talked about this in the past. Now,
yeah, we have.
Historically, it's hard to keep up with inflation when you are in super secure investments or even cash or cash equivalents. The time value of money, if you just had, the old adage of putting the money under your mattress or burying it in the backyard.
You stuff it in your mattress, Josh.
Stuff it in your mattress. Whatever the case may be, if you were to revisit that money 20 years later, it's going to be it has significant less buying power than it did when you stuffed it. Right? Or, as I've talked about, there was somebody that left the Britain, United Kingdom, gosh, what was it? $5 million in 1920.
Oh, yeah. You talked about that in another episode. Yeah.
And it was very conservatively invested, and now it's worth $500 million.
Yeah.
And that's not even, it was like 100 years later.
And they can pay off their debts and stuff.
So what's the point of that? Having the different buckets. You want to have something in your portfolio arrangement that has a long-term outlook. And what I mean by that is when you have a long-term outlook on that, when you look at the overall stock market, it tends to go up and to the right on valuations. Now, it does it in a roller coaster pattern that you don't necessarily want to deal with in the short run. That's going to be your shorter term bucket. So you're going to have a long-term bucket that's going to be it's going to hold a little bit more risk. You're going to hold a little bit more equity positions. You're going to ignore that bucket for the most part, because the point of that bucket is to fill your shorter term bucket with interest and dividends. If there's times where maybe the market runs up and you can take some cream off the top and put it in your short-term bucket. If you were at the casino, you would recognize this. You came in with $50, you won 100, you put $50 in your pocket and you keep playing the 50, right?
Yeah.
House money. And then finally, your last bucket's going to be your stuff that's actually in your bank account. You're looking at, short-term CDs. You're looking at money market funds and money market accounts, or you're just looking at straight up cash or savings accounts. But everything needs to have a purpose. And the main takeaway from this, I love this article. We use Schwab as obviously a custodian. They've got a lot of good common sense data out there. The main thing is, you always, even if you're a really, really, really conservative investor, you still want to have at least one piece of it that's going to be long-term and out there fighting the inflation battle and hopefully keeping you ahead so you're not the guy that buried it in the backyard. Hey, look, I buried $5,000. Well, congratulations. 20 years from now, that doesn't get you very much, right? You get the idea. So very good. All right, is that it?
I'd still take it, though. Some ground money.
Some ground money.
Yeah.
All right. Well, Michelle, great job with the headlines as always. These are always important pieces of information. We feel like those impact those of you in or near retirement. Now, listeners, if you have questions around the topics in our headlines, or if you just have questions about your investment strategy or your financial plan, you can set an appointment by calling us at 251-327-2124. I answer that phone, or at least I try to. Or you can go to our website, gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast as in the show title, FA as in financialadvisor.com. Calendar link, upper right-hand corner. That will schedule something, put something on our calendar. That will be a free, no pressure, no obligation, no BS meeting, okay? All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong?
Yes.
I don't know about that. How wrong? Maybe a little. So what I think is going to affect investors in the near future, or possibly even the long-term future, we get to talk about all these things and poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Null here, alongside co-host Michelle Lee. So I'm opinionated. I have strong opinions at times. I would say a radio show's laughing.
Yeah.
I would say a radio show that probably wouldn't be very interesting to listen to, right?
Wishy-washy's not very interesting.
That's right. And I'm also paid in my profession as a financial advisor to offer professional guidance and opinions to my clients. Otherwise, again, what use would I be?
That's right.
Now, sometimes I feel so strongly about something, I talk about it publicly. And while I feel like I'm usually fairly right because I'm fairly skeptical about my industry, there are times that I swing and miss. So if you want to hear me beat my chest or maybe eat a little crow, let's get at it with Josh's crystal ball and big mouth. All right, Michelle, what's up? What's first?
Okay, so Josh, you've stated that based on your previous real estate and construction experience, high interest rates would slow down construction and home sales more than what realtors were anticipating, especially those that started their careers after 2009.
Right.
So we know what happened in 2008.
Yes, we do.
So with recent reports showing that existing home sales have dropped to their lowest pace since October 2010, with the percentage of new home buyers plunging while the percentage of all cash buyers jumping, what's your crystal ball got to say about where the housing market is headed for the rest of this year, which is wrapping up rapidly, and into next year, 2024?
Well, okay, so first, to be fair, my big mouth on how this was going to affect the local realtors or just realtors in general, I've been a little bit off. I thought this would hit them harder than it did, earlier than it did.
You say that we're in a bubble, sort of.
We are. We're down here. And what Michelle means by that, it's not a bubble as far as the stock market, but as far as local demand for housing in lower Alabama, Baldwin County specifically, because most real estate's kind of like politics. It's local. Baldwin County, for those of you all listeners that are not familiar with what we've got going on down here in lower Alabama, Fairhope, Eastern Shore, to be fair, even Pensacola and Mobile are doing reasonably well, but especially in Baldwin County, we are one of the fastest growing areas
That's right.
in the Southeast United States, if not the United States at certain times, depending on how you look at numbers, right?
Or New York Times.
So even with, high interest rates and all that, what's held steady down here has been demand. The problem is this, though. We have a severe lack of supply, right? So what's compare and contrast this to 2008, 2009, where we had radically oversupply of housing stock. Right now, and particularly down here, we don't have enough housing. So what you have, and this circles back to what I was saying with the realtors, is, okay, it's fantastic that you've got demand, and when you have high demand and low supply, that means prices are going to stay high or rise, right?
Mm-hmm.
The problem is you lose the churn, you lose the transactions. There's just not a simply, and that's why the home sales data is dropping, because there's just not enough transactions to happen.
That's right.
What do we need? We need more housing. We need density.
More affordable housing.
Yeah, I just lost like half our listeners. We need density. We need places for people to live.
We do need places for people to live.
You can't just buy it and shut the gate and hope that no one else wants to be here. It's not how it works. But I do think, and we'll circle back to this 6 months from now, Michelle, but I do think I'm friends with a lot of them, but I think our realtors are in for a real slog. And I think it's going to be a real wake-up call for a lot of them that are newer to the industry, and I feel bad for them. But I could be wrong. We'll see. All right.
Okay.
I think I'm right there.
All right. Okay.
In fact, I think it's happening to a lot of them. They don't want to admit it yet.
I suspect that.
And
I
went through it too. And I can tell you from experience, because I had the highest of the highs and lowest of the lows when it came to real estate back in the 2000s. The quicker that you accept it and pivot, the better off you'll be.
All right. Okay.
All right.
So we usually talk about whether opinions that come out of your big mouth are right or wrong in this segment. So let's mix it up with a prediction.
All right. There we go.
All right, Nostradamus. During 2023, you've made some major changes to your office space and to the service offerings of Gulf Coast Financial Advisors. So, do you mind detailing what those changes are and why you made them, and more importantly, what you think it will do for your business for the rest of this year and into the next?
That's a prediction part, right?
Yes.
All right. So here,
you got to talk about what you did, but then how's that?
Where are we going from there? So let's talk about this. Gulf Coast Financial Advisors started out as a hope and a dream, right? It started out with basically a glorified closet office in downtown Fairhope. Many thanks to my first landlord, Bob Manick, wonderful man. I think he felt pity on me. He had a little bitty space available in an office that was otherwise fully booked. He gave me a shot, and we started scratching and clawing from then, right? As we grew, we eventually kind of outgrew that space. Bob had moved on, retired, had some realtors come in. They were great, but they had a need for a lot of space, and parking is always an issue in downtown Fairhope and yada, yada, yada. So we moved south of town for a little bit. That was fine. But here recently, this is where Michelle was going with this, where she was trying to prod me. As far as office space goes, two things have happened. Now, regular listeners will already know that we opened an Orange Beach office back in, May or June. Isn't that pitiful? But we opened an Orange Beach office serving down there, Foley, Orange Beach, Gulf Shores, even parts of Pensacola. That's been fantastic. The office is awesome. It's off of Cypress Village Drive and Canal Street. It's called the Executive Office Cypress Village. Wonderful looking space. Just new announcing to you listeners, we are moving our Fairhope office to, locals will know the place, Portico.
That's right.
Beautiful, fantastic.
On Fairhope.
I'm going to have to shave every day. It looks so nice. I'm going to have to dress up, right?
That's good. That's not a bad thing.
That's not a bad thing. I
Right.
can't, I'm going to have to polish my boots and
Yes.
shave my face. It is a beautiful spot in Portico.
And act right.
And act right. Good luck with that. But we're super excited. For those of you not familiar with Portico, or at least by name, if you come into downtown Fairhope off of Fairhope Avenue, it is just to the east of the mail post office.
That's east.
Yeah, just the east
West
post
is water.
office. 2-story building, new construction there. We'll be in the second story. We're really excited. All right, as far as services and offerings, we added tax planning officially this year. We have a financial advisor first, but he's CPA by training, Will Stye. 25 plus years. It's probably going on 30 now. I've been saying 25 for a while, but he's got many, many years of CPA tax planning. We're not here to do tax preparation, but we do tax planning, and it's awesome. The things he does are really impressive with helping people find tax deductions and things like that, planning ahead versus looking back. And then estate planning and wills and trusts. And that is yours truly that you're listening to across the table here.
Boom.
You've got your JD.
Right.
J period, D period. I learned
Juris Doctorate,
from the University of Denver. And you serve as a consultant for Gulf Coast Financial Advisors. You help people with wills and trusts and estates and all those things. And you're awesome. So that's kind of what has changed in 2023. It's funny when you're in the moment, you don't realize how much is changing. You look back, you're like, wow, we've grown a lot. What do I think is going to happen?
You say nothing happened to you.
And nothing, I know, right? I think I think we are poised. Come out of the gate, 2023, 2024, into 2024. I'm really excited. We got some things possibly happening in Pensacola. I think we'll probably double the size of the practice, both in assets that we manage, probably in revenue and probably in advisors. So we're excited. And it's been a long slog, as regular listeners will know. I do everything the hard way and butt backwards.
That's how you came into the world.
That's right. And I have not stopped. But on the flip side, what happens is when you build something that way, it tends to be set in concrete. Because when you do it the hard way and you chisel it out of stone, there is nothing soft and gushy about what we have built. This sucker is poured in concrete, and we're ready for you. So come check us out, especially when we get the new office open next week in Fairhope. All right, very good. There you go. All right, we got
one more prediction.
More predictions.
Okay, this jumping to the macro look at the economy. The Federal Reserve meets again next week, Thursday, I believe. At their September meeting, it was decided to keep rates steady at 5.25% to 5.5%, which is considered a hawkish pause,
right?
As in the bird,
yep.
Hawkish pause.
Your spirit animal.
That's right. Pause to provide some relief for the banking sector and stock market. However, many analysts, yes, nailed it again, are predicting that the Fed will raise rates one more time either next week or at their December meeting, which I think would be a complete drag in December. I mean, if they're going to do it, just do it now.
Fair.
Because Christmas and the holidays, it's just kind of like mean. Okay. So what's your crystal ball have to say about the rate increases this year? And I'd like to hear what you think about next year. We'll save this bit so we can hopefully come back to it to see how you did. Either make fun of you or celebrate you.
Yeah, no doubt. Yeah, my crystal ball and big mouth. So we've already talked about the differences between Alan Greenspan and Jerome Powell, past Fed chairman, current Fed chair.
I don't think Alan Greenspan went to Grateful Dead shows.
Fair. But I think Greenspan was way more in tune with what was going on in the stock market and the overall economy. And I think he wasn't the only one. It started before him. But he's really conditioned investors to that the Fed is going to come to the rescue. And
it just reminds me of like when people come to your door, that joke, we're from the government and we're here to help. Nightmare.
Right. What's the worst thing somebody can say to you?
Exactly.
Right? So I think let's get to the point. I think that amazingly enough,
I think it's going on record.
I think amazingly enough, he's going to raise rates in December. I think he's going to hold steady in November. We're going to get more economic data that doesn't make a lick of sense because we see all these people, the young people, where we're not sure what the heck they do for a living. And he's going to raise rates again because he is obsessed with this 2% inflation goal.
He is obsessed with that.
He needs, again.
You think he needs to get over it?
And here, again, I'm just, what am I? I'm a financial advisor in Lower Alabama. This guy's obviously very smart. But now coming in 2024, there's gonna come a point where the housing economy is too important a part of the overall. And the thing is fine that you tamp down demand, but what you're doing is also you're tamping down supply because home builders, just like my dad did in the early 80s, he doesn't want to take out a loan for 15% to build a house. It's too much risk.
Yeah.
So they're gonna have to, at some point, in my opinion, here's my prediction, they're gonna have to just throw the 2% out the window, get it to a reasonable number. It's going to take years probably to get that Goldilocks moment we had, 3 or 4 years ago before COVID hit. And you're going to have to probably be reasonable with the rates so that you can help some of the parts of our economy, particularly the parts that require borrowing. So that's my prediction. Like it?
Sure.
All right, very good.
We'll see how you do.
We'll see how I do. Well, listeners, I hope you enjoyed a peek behind the curtain, how I form my opinions. And more importantly, I'm willing to admit when I am wrong.
Mostly.
Now, listeners, if you have more questions about the various investments and topics that we discussed in this segment, we once again invite you to reach out to us. You can call anytime, 251-327-2124, or you can make an appointment on our website, gulfcoastfa.com, Gulf like the Gulf of Mexico, Coast, FA as a financial advisor.com. Well, folks, that's it for us this week here in Coastal Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton.
You're welcome.
Thank you to our awesome radio show, FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music. That's local band Sloth Racer. Sloth is in the slow mammal. The music is not. And as always, my sincere appreciation for those of you out there that have been listening and joining us on this journey. We'd love to be part of your financial journey as well. Till we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.